Over the last 2 weeks, volatility has returned to many different markets. Some traders believe it's caused by the Federal Reserve's pivot to a more hawkish tone, while others are watching emerging pandemic headlines, or it could simply be market positioning. Regardless of the cause, we saw an exit from traditional risk-on assets, like equities, and a rush into traditional risk-off assets, like Treasury bonds and the US dollar. An interesting theme that also emerged was the selling of Bitcoin along with other risk assets. Now, some may argue that if Bitcoin is a dollar hedge, then it's susceptible to corrections at times when the dollar strengthens. But others have claimed that Bitcoin may eventually be a store of value and attract buyers in times of market stress. One thing that was clear is that at the same time Treasury yields were falling, Bitcoin was falling as well. Now, if a trader feels that this relationship might persist and believes that another risk-off episode could be a headwind for a long Bitcoin position, an example of a way to provide a partial hedge would be to sell the CME December micro 10-year Treasury futures contract priced in yield terms at a current level of 1.47 and target the August lows of 1.18 with a stop at 1.59. Now, this trade could make a potential $290 with a risk of 120 if you're stopped out at your level. Now, if a trader feels that we are past this bout of market volatility and that rates may move higher, one example of how to express this will be to buy that 10-year CME micro 10-year Treasury futures contract at that current level of 1.47 and target the 1.9 level, which was the level just prior to the pandemic, and place a stop at 1.28. This trade could make $430 and risk $190 if stopped out at your level.